So what I want you to think of when you're financing a property and a property doesn't work traditionally, think of the alternative creative ways: seller financing, seller carrybacks. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video, we're going to be discussing the top 3 to 4 ways that you can finance your multifamily. So if you're in the process of getting into multifamily, you're looking at real estate in commercial, and you want to learn how to finance your next deal, then listen on. If you've been listening to the channel, the Jake and Gino channel, over the last 5 or 6 years, we've been focusing specifically on multifamily, and we've been growing the channel. Now, what I want you to do is I want you to subscribe to the channel because we've added a new feature. Jake and I do weekly lessons for our mentorship students. Every Monday, we bring on an expert guest. What we're going to do on YouTube is we're going to add that content, and to anyone who's subscribed to the channel is going to be getting additional behind-the-scenes content only for our mentorship students. So if you want that content that's relevant to you, we're interviewing syndication attorneys, we're interviewing cost segregation specialists, how to raise capital, all of the different lessons that we're doing. If you want that content, then I want you to subscribe to the channel. Now let's get back to financing a multifamily. And this is the first thing that I need you to realize, that most beginning investors don't realize, or maybe they don't even understand. There's 2 big differences in multifamily versus residential. The first one is deal flow. We're not going to get into it here, but just to say quickly, deal flow in residential, you go online, boom, you find a deal, brokers aren't that important. In multifamily, you need to really learn and get to know the brokers. It's more of what we call a closed system, the good old boys club. Commercial real estate, it's a lot harder to disrupt. They've disrupted the single family space. So getting deal flow is more of an open source. The other difference between single families and multifamily is the financing aspect of it. And it can be challenging if you're first starting out. You don't know where to get a loan. You don't know about the difference in financing. The first big component is when you're getting a loan in residential, they're typically 30-year fully amortizing loans. It means the amortization on the loan is 30 years long. So if you pay your mortgage every month for the next 30 years, at the end of 30 years, it's amortized. The word amortized comes from the French word amort, which means to die. So your mortgage is dead at the end of 30 years. Payments are the same every month. At the end of 30 years, dead. You have no more mortgage left. It's paid off. In commercial, you may still have a 30-year amortized loan. It doesn't get fully amortized, unfortunately. Typically, in a commercial loan, there's something we call a term or a balloon payment. It can either be 5 years, it can be 7 years, it can be 10 years, sometimes 12, sometimes 15. But at that point, when the term is up, it's either going to balloon. So if you have a $3 million loan, with a 30-year amortization, with a 10-year term, at the end of 10 years, you may have paid off $300,000 or $400,000 of that loan, maybe a little bit more. You still have the remaining balance. That loan either comes due with a balloon payment, and or that rate that you have, what was locked, goes to a floating rate. You need to understand that. And when Jake and I remember doing our second deal, we got a 3-year term. Now, thankfully for us, we were able to refinance the property, and after about a year and a half, we were able to refinance it out into a longer term. But understanding that is so important. That's a huge difference. Don't think you're going to buy a multifamily and say, I'm going to hold this thing forever. I mean, hopefully you do. And hopefully after 5 or 6 years, you start to see where rates are, part of the market cycle. That's very, very important to understand the 3 pillars of real estate. We've talked about that on another podcast. Know what your exit strategy is. You need to understand that, hey, if I'm going to buy this deal long-term, I can't get short-term debt because you know what? Debt's going to expire. Or if I want to flip this thing after 2 or 3 years, I can't get longer-term 10-year debt. Understanding that's really important. And that's one of the big differences between residential when you're getting financing versus commercial. Now, what's the first way to finance a multifamily? And I'll start with the easiest one, the one that's got the lowest hanging fruit, and the one that right now to me is really coming into season in this part of the market cycle. And it's even when Jake and I started, it's seller financing or seller carryback, where you've got a seller who has a ton of equity in the property. And let's say they have a $300,000 property and they have no debt. Well, they can become the bank. they can finance that property for you. It's called a seller carryback, purchase money mortgage, seller financing, holding paper, whatever you want to call it. It's the same thing. That is an awesome way. Now, in certain instances, a lot of these sellers have a significant amount of equity, but they don't have all of it to be able to finance the entire property. So what they do is they do a portion of something called a seller carryback. Let me give you a quick example. On the property that Jake and I closed on in August of 2015, it was an $11 million deal. It was 281 units. At the time was a lot of money. Now that's significantly gone up, but it was in part of the market cycle where it was very difficult to finance. There wasn't a lot of buyers out there. The seller was very motivated, and you're seeing that in this part of the market cycle. Financing was a little bit more difficult, so we went out and we secured a bank loan for 80%, and the seller carried the remaining 20% of the down payment as a seller financed note. Now you're going to say to yourself, well, why would he do that? Well, we asked him, Mr. Seller, what are you going to do with the remaining 20%, which is a little bit over $2 million? He said, I'm just going to put it in the bank. Well, banks back then were paying 1.5%. Well, we were willing to offer him 5% of his money. At 5% at $2 million, it's $100,000. 1% at $2 million, it's $20,000. You can see the big difference. So he was willing to take that note because he was going to get a lot more money on the interest just sitting in the bank. Great way to finance a property. Now, one of the things that I want you to understand with seller financing is don't go looking just for a deal if it qualifies for seller financing. Underwrite a deal traditionally. We underwrote this deal traditionally, and believe it or not, it didn't work because the income was so suppressed. They were collecting $140,000 a month. Don't know where the remainder of that was going because the first month we took over, we collected $170,000. So on actual numbers, back then, it didn't qualify for a loan. And you would say to yourself, why is the bank allowing you to do that? Because the bank already saw that Jake and I had several hundred units. We already knew more or less the business. We had a great business plan. The asset we were buying was phenomenal. And what happens if we stop paying the mortgage, the note? The gentleman's just going to foreclose on us, take the property over, and the banks still hold. Banks still got the 80%. The seller's still going to continue to make mortgage payments. So they had very little risk. So what I want you to think of when you're financing a property and a property doesn't work traditionally, think of the alternative creative ways. Seller financing, seller carrybacks, and asset lease options falls into that bucket. Now, if you want to learn more about that, email me, Gino at jakeandgino.com, and I will forward you over a PDF copy of Creative Cash. Creative Cash dives into all of those strategies of seller financing and master lease options. It's a great tool in the tool belt. And for the next, I would say, market cycle, 12 to 18 months, it's going to be very prevalent as for you to be able to use it. Now, the second one, how are you financing a multifamily or a commercial property? The old-fashioned way, community banks. Community banks are a phenomenal resource. Now, for us, so this past market cycle, as we've seen rates go up, community banks have become a lot less competitive with rates, with terms. We've actually shifted over to using credit unions. So if you're looking at financing right now, and credit unions, believe it or not, they're non-for-profit. They are technically not a bank, but their closing costs are so low. They've given us interest only. They've given us a much better rate competitively on these deals. And they go out to 25 years on their amortization, and some are going to 30 years. So look at them as an alternative. Go shop your community banks in the market, and also go and shop the credit unions as well. This next one is the agencies, Fannie and Freddie. Now, if you're just getting into multifamily, it may be challenging to finance it with Fannie and Freddie because they're becoming more stringent right now. They want people who have a little bit of experience. Now, Freddie, small balance, they may not require it. Maybe if your partners have it, or if you're getting third-party property management, they may allow it. But typically, when you're first getting into it, it's much more challenging to use the agencies. What our strategy has been over the last dozen years plus is we finance them out with community or credit union, we stabilize the properties, and then we refinance and bring it over to agency. Great way to pull the equity out, great way to get a deal that's on recourse debt, get it over to non-recourse with the agencies. Phenomenal way to use it. If you have it, awesome. Start thinking about how you're going to be able to use the agencies to finance one of your properties. This next one has really come into fashion, into vogue the last market cycle. It's syndication. You're always saying to yourself, well, where am I going to get the money to finance my deal? Well, syndication is a great way to finance the down payment, to finance those hard costs. You're obviously going to go to an agency, a community bank, credit union to finance the remainder of it. But if you don't have access to funds, use and consider the model of syndication. You can absolutely get money from others to invest. Financing as well. If you're looking and you don't want to syndicate, you don't want to go through the whole process of creating, securities documents and private placement memorandums. Financing a multifamily, the down payment, look out and go look to JV partners with others. Bring a team together as long as you are all doing work on that team and not creating a security. Go out and partner with others and work together on that deal and take that deal down. I think this last one is something that we've utilized a lot. Actually, we've been able to refinance over $25 million of funds in our portfolio. But this is another way to finance your next multifamily. So you're saying to yourself, how am I going to get money for these deals? I'm going to run out of money. And eventually you do. That's why syndication is a great tool to bridge the gap. We used it back in 2018. We did 3 syndications because we were running out of money. We just waited for our older deals to matriculate, to get the value. And then we were able to refinance that equity out and go put that money into the next deal. Always going back and using a credit union, community bank, or agency to finance the big portion. Now, what I want to do is I want to shift your mind or really change your paradigm on what a bank really is. And I've learned this over the last couple of years because I always thought to myself, well, banks, who needs them? They're greedy. They're a pain in the neck to work with. But then when one of my mentors told me, listen, Gino, how would you feel if someone was bringing 80% or you were bringing 80% of the funds to this deal? Wouldn't you be a little bit more challenging? Wouldn't you be a little bit more stringent? They are, and I want you to really think about this, they are one of your biggest, if not your biggest partner in the deal. They are so important. Do what you say and say what you do when you work with banks. Be very punctual. If they need a document, get the document over. If they want to schedule real estate owned, get it over quickly. They want your personal financial statement, get that over as quick as possible because they are your biggest partner. In some instances, 70%, 75, 80%, they're bringing 80% of the equity over. So don't only look at banks, these evil institutions that want to make money off of you. Hey, they're trying to protect their shareholders and their bank by making sure that your deal is a good deal. And it's great. I mean, the agencies are telling you, if you look at what they're looking to invest in you as an operator, they're telling you the pitfalls. They're telling you all the stuff that they're looking at and saying, hey, CapEx, you need to put this money aside. Railings got to be 36 inches high. Roofs are too old. Mechanicals, they're letting you know. So start using their data when you're actually looking at deals. But to get back and really to wrap this whole entire thing up, there's several ways to invest in multifamily and to finance a multifamily. But always remember, go back to the beginning, that huge difference, understanding the financing, understanding the terms of multifamily, how they differ a little bit from residential. And that difference can sink you or can put you back a ways if you don't understand it. Now, once again, subscribe to the channel. Get that premium content that's only available if you subscribe to the Jake and Gino channel. Give me a big thumbs up if you like the video. Email me for that book, gino@jakeandgino.com. And once again, thanks for spending part of your day with me, and I will see you on next week's How-To. Take care, everyone. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.